Hi guys, today we're going to talk about income statements. Income statement is one of the key financial statements to determine company's financial performance over a certain period of time. This is accompanied by balance sheet and statements of cash flows. In addition to company's performance reports, the income statement must be supplied to the Securities of Exchange Commission. An income statement provides an information about an income through a particular period of time, and its heading indicates this period. Balance sheet provides a snapshot of company's financials at a certain point in time. There are 4 key items on income statement: revenue, expenses, gains and losses. Cash and non-cash receipts are not distinguishable. Cash sales versus sales on credit, or cash payments versus non-cash receipts. Cash purchases versus purchases on credit. After collecting the information about the sales, the net income and EPS are calculated. It shows how the net revenue realized by the company is transformed into earnings, profit or loss. Let's talk about revenues and gains. Income statements include the following information, though their format may vary depending on the local regulatory requirements, the diversified scope of business, and the associated operating activities, such as operating revenue. This is the revenue that is achieved via sales of the product, for example, companies in its wholesales, distribution or retail industry. Similarly, if the company operates in business offering services, the revenue is then achieved via business services of what the company offers. Non-operating revenues, these revenues are realized through secondary business activities. A good example of this would be a capital that is present in the bank, business property, royalties generated from patents and such. These are other income activities that are usually one-time deals that are not standard business activities. Expenses and losses. The cost of business to continue operation to turn a profit is known as an expense. Primary activity expenses. Expenses related to the primary activity of the business incurred for the purposes of earning the usual operating revenue. They include operating costs, selling, general and administrative, depreciation, amortization, and research and development expenses. Typical items include employee wages, commissions, and transportation and utility fees. Secondary activity expenses are all expenses linked to the non-core business activities, like interest paid on loan money, losses as expenses. All expenses that go towards loss-making sales of long-term assets, one-time or any other unusual costs, or expenses towards a lawsuit. Balance sheet presents company assets, liabilities, and shareholder equity at a specific point in time. Investors use balance sheets to compute rates of return and to evaluate companies' capital structure. In summary, the balance sheet is a financial statement that shows where a company stands financially, including what assets it has, as well as what debt it owns. It can be used for fundamental analysis or calculation of financial ratios. Let's say a company A gets a loan from the bank. The company's liabilities increase by the amount of the loan. At the same time, the assets of the company increase at the same amount. At this point, the balance sheet is imbalanced. Company then purchases equipment and produces electronics. The cash assets then decrease, but it's balanced by the new equipment bought. As the company produces products to sell, the retaining earnings increase, while the profit is increased in the assets. This way it balances out. Company then pays back every month the loan. This makes the assets and liabilities decrease at the same rate. To get the information how much is the company's business worth, we must then subtract assets from liabilities to get the net worth. Cash flow statement summarizes all cash inflows into the company's operating and external investment activities. In addition, cash outflows for investment activities and business activities are included in this category. Cash flow means the movement of cash into or out of the account, business or an investment. When the cash inflow is superior to the cash outflow, this means company is doing well, or rather good financial health. This applies to a person or a company. Let's have a look how this works. For company A, cash flow is essential for business and it pays for employees and its creditors. There are 3 types of cash flows, generally speaking. Operational cash flows. This means cash spent and received for various business activities the company does. This could be, for example, the company receives cash from sales, what it then uses to pay for employees and its supplies. Let's also add a CEO to the equation. The CEO will then pay himself a salary and he will pay for whatever expenses that needs to be covered, be that food, bills, or other expenses. Investment cash flows. As the name suggests, this is cash received or spent through investing activities. This could be purchasing and selling assets that could benefit the company's economic growth. Financing cash flows. This is cash received through a debt or paid out as a debt repayments. This works, for example, a company would issue a stock that would pay down its debt, then repurchasing shares. This maneuver would count as a financial cash flows. If the company fails to pay its debt or obligations, it would then experience cash flow crunch. In order to escape bankruptcy or other financial punishment, the company will have to arrange a bridge loan. This is why company as well as individuals should always consider emergency cash reserves in case of any financial turmoil that might occur within the economy or their personal life.